Hello, everybody, and welcome to the Investing with IBD podcast. It's Justin Nielsen, your host, and joining me, as he does every week, is Arusha Pires. He is an O'Neill Global Advisors portfolio manager. We were supposed to have John Najarian on from Market Rebellion, but unfortunately, he got stuck in a conference in Miami. So we're going to have him on at another time. So, hey, looks like you're stuck with us this time around. But we've got a lot of stuff to talk about, specifically this market that has been so strong to start the year. And the question on everyone's minds is this for real, or is it another bear market rally trap? So, Arusha, let's just kind of get your opening thoughts on how the market's been treating you to start 2023.
Well, yeah, I mean the market has been treating me pretty well. I honestly I've been a little bit slower to move into the market, and that's my own fault because I haven't listened to it. All the signals. We're going to go over a number of these signals,
Right.
and it's amazing at how many signals that there were. So I wish I was more aggressive, but don't we always kind of wish that we always had more money earlier on? But
It's always
it
easy in hindsight, right?
it is always easy in hindsight, yeah,
Uh,
and I mean, what I always tell, I've said this before, and is that, and I tell myself this, is that you're always going to be miserable in the markets, right?
mhm.
You're always gonna not have enough money when the markets are working. You're always gonna sometimes buy too late, or I mean, sell too late, or buy too soon. You're never gonna do it perfectly. But in the end, as long as you're making money when those windows open, you're making progress, and
Yeah,
then just use that to get better. Uh,
right.
so yeah, the markets are treating me well, as hopefully everyone who's listening too. If you've listened to a number of these signals that have come into the market.
Mhm. And it's worth remembering that while this might make you feel like, oh, I'm too late, and I missed it, if this truly is for real, you've got time.
Yeah.
Remember, bull markets kind of happen over months and years even. So if this is the beginning of a bull market, don't feel like you have to chase too much. And that was kind of our whole thing that we were talking about with Anne Marie Band last week, the whole patience pays idea. Now this week, what we're going to get into is we're going to get into some of the studies and data that we have behind our market school. This is something that Charles Harris, portfolio manager at O'Neill Global Advisors, Mike Webster, a former portfolio manager, and I, put together and did all this data. So we'll go over some of the signals that we use in market school and what some of those mean. And of course, we'll also talk about some stocks that are on our radar, both Arusha and I, and the markets as well. So let's go ahead and pull up some charts real quick, and we can kind of just take a look at what has been happening for uh, the Nasdaq Composite, because the Nasdaq Composite has certainly switched to become the leading index. And remember, this all starts on January 6th. So maybe Arusha, if you can point out that day, on the chart. And what's interesting about this is it really was pretty close to the bear market lows. I
Yeah.
mean, the bear market lows were on October 13th. We had kind of pulled back quite a bit. And December 28th was our more recent low. So we were pretty close to those lows when we had this follow through day. And look, it was. We were still below the 50-day moving average line. We were below the 200-day moving average line. I think there was a lot of reasons to be cautious, but we can talk a little bit about some of the things that we were seeing very early on. And one of the big things was what we call the subsequent follow through day. And the idea behind this is, remember, the follow through day is, you've got a powerful day, volume is heavier than the day before. And what we kind of term the subsequent follow through day is when you see something that qualifies as a follow through day happen after the follow through day. And when you get those signals happening over and over and over again, it just tells you that there's more power to the rally. And one of the things that I was keeping track of is that we actually had uh, the pile up of subsequent follow through days got to such a point that we actually broke a record from the data that I have, the market school
Wow.
data that I have from the Nasdaq. So we can just go through it real quick. We had January 11th. As our first subsequent follow through day. Then we had January 20th, the 23rd, the 26th, the 31st, then the 1st of February, and the 2nd of February. And really Tuesday of this week, just yesterday, we're doing this taping on the 8th of February on Wednesday, but on the 7th of February, we actually had what would have qualified as another day.
Wow.
So
Wow.
that broke a record. It just, we haven't seen that many subsequent follow through days in that first 25-day window in the history of the NASDAQ going back to 1973. So what does that say to you, Irusha?
I think it says that there's plenty of accumulation going on in the markets. Now, all you have to do is just look at the volume on this NASDAQ,
Yeah.
and that's I think that's what's telling me. But I think that additional follow through day, when I learned about that concept in the market school, it made sense because it's almost just constantly knocking on the door. Hey, another one, another one, another one. Now, it doesn't necessarily mean that this really means it's at the beginning of we're at the start of a bull market, right? Anything can happen. It could be massive short covering, right?
Right.
But it really feels like when you just look at that volume, and I think because you definitely could debate, there is a lot of short covering. A lot of these stocks that have the stocks that have done the best are the stocks that got hammered the most last year, right? Which I think at the bottom or near the bottom of a bear market, that's what's going to happen a lot of times. The XRT for this is the retail ETF. This is the most shorted ETF in the market. Apparently, I saw that that data recently, and this went like a rocket ship, right? Right up to that 75 level. And so those last couple of days, and that was probably February 1st and 2nd, that was almost, the shorts kept trying to hold those positions, and they might have been forced to capitulate too, because that volume was, it went kind of vertical and the volume was massive. And so you can bait it whether it's short covering or not. But a lot of times, I think the best thing to do is kind of just take a step back and just look at that price and volume and just take it as is, right? And slowly move in when you have those opportunities in individual stocks. If you see them breaking out, that gives you more reason for exposure. Or in the ETFs, one thing, and I did this a little bit, but I didn't do it enough. But I think you could almost build something, or kind of have an exposure kind of system if you don't see enough stocks breaking out, right? Because I think that's one thing, and maybe we get into that after this, but if you don't see enough stocks breaking out, you could use the ETFs, right? You can use the Qs, or like you, Justin, the TQQs, as, hey, every follow through day, maybe I add a certain more percentage, right? Maybe the first follow through day I add 50% or 25%. Next follow through day I add another 10%, whatever. Come up with your own kind of scaling kind of thing. But that would force you to slowly listen to the market, slowly move in, especially if you're not seeing a lot of individual stocks breaking out, because that's usually the way I'll get much more exposure. I see tons of great stocks breaking out. That's giving me the reason to get more exposure to the market.
And to your point, what was interesting is sometimes some of these ETFs were kind of showing a tell of strength that kind of defied logic. And I think of the home builders, home construction. You could look at either XHB or ITB. Those were skyrocketing, and it's like, wait, the interest rates are going up. It's harder to have homes be affordable. And the home builders are, a potential recession is coming. There's fears of how they're going to navigate the soft landing. Is it going to be even possible? And, you had both of these ETFs really, really skyrocketing. So again, this is sometimes where technical analysis will expose things to you that, like, maybe your fundamental research would kind of lead you astray. You could certainly build a case against these. You could people have been building a case against retail for a very long time, and yet here we are. Here's two very strong ETFs. Now, you did have a lot of things coming off the bottom, and to your earlier point, whether it was short covering or people just saying, okay, these have come down enough. I can't stand it. They're so cheap. I have to get in. There's you can debate a lot of the reasons why, but the fact is, you look at the chart and it's telling you exactly what's happening. One other thing I just wanted to mention, because you brought up volume and how you see that rising volume on the blue days for the Nasdaq Composite. I think equally as important is the lack of volume that we're seeing on the red days.
Yes, exactly.
We just really haven't had much in the way of distribution. Yes, a lot of those days have been above average, but they always seem to come in lower than the previous day. And that was Bill's definition of distribution. When you had distribution, that's when it comes in higher than the previous day. It doesn't have to be above average, just higher than the previous day. And that was what was more important to him. And so far, the trend has been lower volume on the down days.
Yeah, and with all of this, and with such a powerful start to the year, all of these accumulation days, we're still, when you take a step back and look at the longer trend, and I switched over the weekly chart here on the Nasdaq, we're still in a downtrend. The longer one. So, yeah, until we really break on the Nasdaq, that 13,181 level, and now start establishing more of a higher high, you're still in a longer term bear or a downtrend, a shorter term kind of uptrend, because you started to take out shorter term kind of. We've taken the first step, but we haven't taken that next step that's breaking even more downtrends or becoming a more significant uptrend. So you just want to keep that in mind. So the fundamental, both the technicians and the fundamental focus people, they both could be right in the end. It's just different time frames, right? This could be a sharp bear market rally right into that 13,000 level, and then the downtrend could resume, and that would make both people right. In the end. So it really does come down to that time frame. But from our perspective, I think the biggest thing is you want to keep it simple. We've had a follow through day. We've had a number of additional follow through days. You're starting to see a bunch of stocks starting to act better and better. And so you should have exposure to this market.
Right. And one of the things that we also have is what Market School termed a power trend. So we'll talk a little bit more about that. And basically the idea behind a power trend is, that it's you're getting to a point where the uptrend has had enough oomph behind it that it's something that can last. But of course, not all power trends are created equal. So we'll talk a little bit more about some of those historical examples, some historical examples of the subsequent follow-through days, and we'll get all into that in our next segment. So stay tuned. We'll be right back.
The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive.
Okay, welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, and Irusha Paris is joining me as he does every week. He's an O'Neill Global Advisors portfolio manager and my weekly special guest, always joining me to hash through the market and what's happening. So let's talk a little bit about the concept of getting back in and how you know it's for real. Certainly, one of the things that has been a little frustrating here is that while the indexes have been really strong, specifically the NASDAQ, I mean, this was such a phenomenal January for the NASDAQ Composite to start the year. There are still those landmines out there. So maybe you could talk a little bit about that, Arusha. I feel like for me personally, I'm seeing more stocks get up to 20%, whereas before it was like, oh man, if I had 10%, I better take it because it was going to, get taken away from me quickly. I've had more go up 20%, but there's still a lot of stocks that just seem to get hit out of nowhere.
Yeah, it really this is not necessarily, even though with all those fall through days what we had, it's not necessarily an easy market, right? Mark Minervini terms it, hard dollar, easy
Hard
money.
penny.
Hard
penny, easy
penny,
dollar.
easy dollar. Thank you.
Yeah.
Yeah, it's not an easy dollar just yet. It's starting to get a little bit better, but there are plenty of landmines out there, and there are plenty of stocks that are still kind of going up to 5% and not making a lot of progress. So it really just comes down to your experience, and if you've been in some of those stocks that have had more trouble or aren't moving as fast, then maybe you don't have as much exposure, right? So it really just comes down to how you're doing. And if you're making progress, if you're proving it to yourself just by the trading success, then that gives you more ability to have more exposure to the market. So it doesn't necessarily mean everyone, even though the market's had all this huge run on the indices, doesn't necessarily mean that we should all be on margin, right? Because there have been plenty of stocks that have been tricky in this market.
And it's important that we continually use the market as a feedback mechanism, right? You put some money out there, and rather than putting it all in at once, because you never know if the market is going to work or not, the benefit that we have is that we can make incremental bets. Basically, you can get in a little bit at a time, and as the market starts proving that your decisions are right and you're on the right track, then you put more out, and that's how you get fully invested, or even on margin when the conditions are right. And on the flip side, when you keep on getting slapped down, rather than touching that hot stove over and over again, you just back away a little bit and say, okay, you know what, I'm gonna ease my exposure. I'm going to wait and see if I can get some better setups. Maybe even do a quick little post analysis and say, hey, am I doing something wrong here, or is it just an effect of the market? And certainly when, like what happened in 2022, when you're below the 200-day moving average line, when you're below the 50-day line for so much of the time, that you're in a downtrend. You have to also change your rules, in terms of buying. You have to be more cognizant of defense and recognize that a lot of the patterns aren't going to work because it's a bear market. And that was something that Bill O'Neill was very vocal about and wrote in big, bold letters in his books, loud warning to the wise. A lot of the stuff that we're talking about here is not going to work in a bear market.
Yeah, and looking back in history, we theoretically, when we had that March fall through day in 2009, it really took like 4 months. Before O'Neill type of can slim type of stocks really set up kind of our classic patterns that we look for, and then worked really well. So it was pretty tricky during that year. Or even in 2002, we had a fall through day in October of 2002 that worked for 6-7 weeks and then came back in pretty hard. And then eventually we had the March 2003 that ended up working a lot better. And there were a lot more bases in more of the growth type of stocks that were breaking out powerfully. So we might be in that one of those kind of phases where stocks are starting to act better. You're starting to make a little bit of progress, but it's not tons of stocks with great growth potential breaking out of perfect bases on powerful breakouts, and you kind of feel like that kid in the candy store. So I kind of feel like we're in that phase where we're setting ourselves up for an even better kind of run down the line.
Well, I'm glad you bring up that 2002 example. Maybe we could just kind of do a historical look there, because there are a few things that are, I think, worth noting in terms of some similarities. So if we go back to, maybe go back to like March 03, or, maybe even May of 03, because that can kind of show how March played out. And again, this is where the change date feature comes in real handy on MarketSmith, so you can kind of see what things looked like at the time. And this is a market where, remember, the NASDAQ composite had come down 79% off of its peak. We had just a lot of this these rallies, some very strong rallies, but the 200-day moving average line was containing the move, to the downside. Sound familiar?
Yeah.
And we had also, just so you know, in October of 2002, I'm looking at my spreadsheet right now. We had a follow-through day on October 15th, 2002,
Yep.
and we had a number of subsequent follow-through days. So we had one on October 17th, a little bit of distance, October 30th, November 1st, November 4th, November 6th, and then November 12th. So until this last one, that was a tie for some of the most subsequent follow-through days that we had.
So Justin,
now,
okay, so how many were those right there in that
so
25 window? What
in
was
that
the number?
25-day window, so
Yeah.
you had the follow-through day plus 6 subsequent follow-through days.
Okay, so total 7 there.
Yeah.
For this current rally that we're in, how many in that first 25?
So in the first 25 days, we had the follow-through day and 7 subsequent follow-through days.
So we've had 8 this time. We had okay.
And then we actually followed it up with another day, but it was just outside of the 25-day window. So I mean, Tuesday was another day that would have qualified otherwise. So we kind of labeled that an accumulation day, but it still would have qualified. So we can also kind of talk a little bit about the concept of the power trend. So again, remember the idea behind the power trend, there's a few things that we look at. The 21-day moving average line is above the 50-day, and the index we also like to see is trending above the 21-day line, so it stays above it for at least 10 days. And then we also like to see that the 50-day moving average line is above or in an uptrend. So if it's in a downtrend, we're not going to call it a power trend. When you have those things in place, then we say, okay, this is something that could be, could be special. This could have some lasting effects. And in this case, the power trend did start. We did get a power trend that started on November 4th. So we had that follow-through day. And then by the time November 4th rolled around, we had all of the elements of a power trend. And look, so we had all of those subsequent follow-through days. We had a power trend that started. By the way, we had a power trend start in this latest rally too. But then we were still below the 200-day moving average line.
Right.
And once we got there, we kind of came in. Now that
was
October low,
classic, right? Because you had the downside reversal and came in.
Yeah. So we had the October low that did hold. And then Bill was very keen on the 3 waves down that got formed at that point. So you had that rally into the 200-day line. You had a single wave down, back to the 200-day line, another wave down, and then you didn't quite get up to the 200-day line, but you had another leg down. And one of the things he noticed was that the volume was starting to kind of pick up on the positive side, and be a little bit less on the negative side. So what ended up happening is the accumulation distribution rating for the index, the NASDAQ composite, ended up switching to an A, or I think it was like an A minus. And then you had the follow-through day that occurred on March 17th,
right.
03. And that's the one that worked. Now, it didn't go straight up. It went kind of sideways for a little bit. But then this is where you had the real power and what really kind of started the bull market that lasted really through the until the great financial crisis. Not straight up the whole time, but certainly a lot of power behind it.
Yeah, and that March 17th, I mean, I clearly remember because that was really kind of the first follow-through day that I really saw following the system, and that was the same day that we went into Iraq.
Right.
And and that always kind of just blew my mind that everyone's worried about what's going on there, and here's the market going, hey, it's a signal to buy, right?
Yeah.
So it's the markets are always going to go do the opposite of what you're hoping. The news was the worst, and the markets are turning at that time. Kind of like that's so that you always want to keep that in mind, because the news, when you look at from a macro level, it's pretty bad, right? You're starting to see. We just saw on Twitter right now that Disney's laying off 7,000 people. You're seeing all these layoffs, and the things, I guess, from a larger perspective are getting worse and worse. But the market a lot of times will kind of discount that in and turn when everyone doesn't expect it.
Right. You know what? One more example that we can show that was also during this kind of bear market, this really horrible dot-com crash that we had. If you kind of go back a little bit earlier, and we've talked about this, the September 11th tragedy happened in 2001, but shortly after, there was a very powerful rally. This rally was a 40% move in the index, and granted, it was short-lived. It didn't work ultimately, but this is another case where you had the follow-through day was on the 28th. So you can kind of see where the 9/11 tragedy happened. The market was closed for 4 days. We went lower after that, so the gap was a little bit earlier than that, 4-day gap where you see kind of the space. We ultimately bottomed out. We had our follow-through day on the 28th, and then a subsequent follow-through day on October 3rd, another one on October 10th, October 11th, October 16th, October 24th, October 25th. So another one where we had a follow-through day plus 6 subsequent follow-through days. And, again, it was kind of showing you that the market was, whether it was short covering, whether it was, just a lot of buying, almost patriotic buying at the time. People were like, we want America to live and, show our faith and everything like that. Now, in this case, we didn't get a power trend until November 19th of 01. That's when I think you had the 21-day above the 50-day for a while, and you just didn't have the low staying above the 21-day, and you also had to wait for that 50-day moving average line to kind of turn into an uptrend. So you can see how it was kind of flattening out, and then it had to turn into an uptrend. So the power trend did come later on this one, November 19th, and it was short-lived. The power trend only lasted until January 28th, 02, and you did make some progress above the 200-day moving average line, and it looked like you were holding above there for a while. This was looking promising,
right?
But it ultimately did fail and go to new lows. That's not to say that that's what's going to happen this time, but I think you have to hold that scenario in your mind that is possible. It is possible that maybe the soft landing doesn't happen. Maybe inflation gets entrenched. There's a lot of maybes behind it, but you have to still have your risk management rules in place because we haven't gotten the all clear signal.
Yeah, and I think that's why the day by day, week by week approach is the most realistic one to stay on top of the market, right? Where you're just kind of taking the new evidence that comes in and letting that guide you. And you're looking at the markets, whether they're above these cumulative averages, where in the power trend, and then you're also looking at those stocks, whether some of the stocks that you've bought, you're actually making progress or not. And I've always found that that's just kind of the best way, and so the market will slowly push you in, pull you in, and slowly push you out. If you're kind of just using those basic metrics to tell you how much exposure to get in or not.
Right, absolutely. One more example, and we'll go ahead and kind of wrap up this learning lesson. But I also wanted to kind of show 1991, because this was the start of such a beautiful bull market. So if we kind of go back to you can go back to 1992 to kind of give some sense, but the follow through day that we will start with is on the 23rd of January in 1991. And this is another case where you just got immediately a lot of evidence. So kind of like what we saw this last time, you had a bottom, you held above the bottom, but in this last instance, we came down a lot more. We came down a lot closer to our October lows. We didn't hold as well. But in 1991, we arguably were in a little bit of a stronger spot to start. And we had the follow through day on January 23rd, a subsequent on the 24th, another subsequent follow through day on the 30th of January, then on February 4th, February 5th, February 6th, and then another one on February 11th. And so, and then you can see it didn't stop there. I mean, this was just, that was nuts.
And so this was the Iraq War one.
Yeah. Persian Gulf, so
it going in Kuwait, right? Iraq going in Kuwait.
And then we did have a power trend, of course, that started here. The power trend started on, actually it started before that follow through day. It started on the 12th of December.
Wow.
So back there. So basically what had happened is it kind of, we had enough distribution and everything like that to kind of reset to where we needed a new follow through day. And but the power trend remained intact in this case. And you can see we actually ended up getting support at the 50-day moving average line. So this was definitely in a different position this time around, a stronger position. But again, if you go forward, to 1995 and look at the weekly, you can see what kind of power started here. And this power trend, by the way, lasted until June of 91 before it got into a little bit of trouble. But overall, this was just such a powerful market, one of the best that we'll ever see. Unfortunately, I was in high school when it started, so
exactly.
I didn't participate.
Neither of us did.
Yeah. So anyway, any final thoughts on kind of the subsequent follow through days and the power trends, some of these historical examples that you want to note here, Irusha?
I think when you use objective signals like this, that's what's going to help you get in around the right time and stay in. Because your psychology is not going to be in the right place during when the markets are turning. You're just going to be so used to, just like we've been used to over the last year, just seeing everything not work.
Yeah.
And so when you see kind of all these indicators saying, hey, we might have a chance here. It's not 100% guarantee, but we might have a chance here. And you're using the follow through day, additional follow through days, and the power trend, that at least is going to put history on your side, and just kind of let the markets and let these signals guide you how much exposure. And then of course in the end, it's your portfolio and how you're making progress, and obviously cutting your losses when things don't work, because as we saw in some of these examples where, hey, you got over the 200-day, things are looking really good, and then all of a sudden it turns around for whatever reason and undercuts, and now you're back in the downtrend, and you have to wait another 3-4 months before something else sets up.
And Irusha, you've said it a couple times already, but I'm just going to go ahead and repeat it. It's not just about the indexes. It's also, you have to look at those individual stocks and your portfolio and the progress you're making and stuff like that, because sometimes growth does take a little bit longer to come on, and so you might not be making the progress immediately because it's things coming off the bottom and the bottom fissures and the short covering that kind of drives it forward at first, before the growth names finally get their setups, get their cups with handles and everything like that. So
yeah, and one more thing, Justin, I would say that, but we are in that time right now where you have all these signals where you want to on the weekends try to do a little bit more work building up those watch lists, and becoming familiar with some of these stocks that are doing well, because they could be the next leaders of a potential new bull market.
Absolutely. So when we come back, we're going to take a look at some of the leaders that are on our watch list. So stay tuned. We'll be right back.
The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host, along with our O'Neill Global Advisors portfolio manager, weekly guest, Irusha Puris. So, Irusha, let's talk a little bit about some of the stocks that are showing up, and it's a little bit of a mixed bag, right? There's some stocks that are already looking extended because they've been running up for a while. There's those that are kind of doing these bottoming bases. They're coming off the bottom, so it's a little tough. But maybe we start with ON Semiconductor. Now, as a reminder, I think, Simon Erickson, when he was on our podcast, he did a deep dive on this and the whole silicon carbide, thing that they're doing, how it's so important for EVs. But if we take a look at this weekly chart, what I love about this is how much tighter the bases are getting. And you can see this by just kind of rolling over with the pattern recognition. It tells you how deep the base is. You've got a depth of 37%, then 28%, and this most recent base just 23%. So yes, it hasn't been making progress, but it also each time seems like it's giving up less too. It just and remember that this has all happened during a bear market. So this has just really been like saying, I don't want to go down. What's your take on it?
Yeah, well, this kind of base, those three bases that you mentioned, Justin, that reminds me of the presentation that we did. We did a seminar years and years ago in Chicago. It was the original trading summit, and a number of us did each kind of unique presentations, and mine was faulty to constructive, where the bases just keep getting tighter and tighter and tighter, and so. This is a pretty good example of that, where you're going from consolidations, which are essentially just trading ranges, right? They're not neat enough. They're not tight enough to become kind of classifying the classic bases that we look for. And then eventually it turns into a cup. So I do own this stock. This is a number of the semiconductors have been acting really, really well. And this, I think, was one of the closer ones that kind of fit more of the traditional type of O'Neill entries, O'Neill type of stocks that we look for, or is one of the better ones, I think. And so this broke out of a cup last week, reported earnings. It got through earnings. It's currently a little extended, 8% from its pivot. And the relative strength line's right at 52-week highs. So on a technical basis, it's pretty good. It is acting well. It's been a little choppy, a little tricky, so it hasn't made it necessarily easy, but it's working. So there is some progress there. Now, when you look at the fundamental side, this is where it gets interesting, and I think this kind of is a good example of the market that we're in. The fundamentals are almost the opposite of ideally what we're looking for. They're pretty good fundamentals still, right? And as Simon Erickson, when he came on,
a lot better than a lot of other things out there.
Yeah.
So on a relative basis, absolutely.
Right. So yeah, the larger story, the trends are definitely in its favor. But when you look at kind of from the O'Neill perspective, you're seeing deceleration of earnings, right? So you're seeing 113% to 67 to 21, and then the sales are also starting to drop, right? You're going last March it was 31%, then went to 25, 26, 14, right? So you are seeing a slowdown in growth. So you're in this kind of weird situation where these are some of the stocks that are working, but the fundamentals aren't necessarily working. So naturally, I've gone in, but I've gone a little bit smaller of position on it just to see, can I get traction on it? If I get traction on this and I lock in the gains for this, that'll give me more confidence to go a little bit bigger, and hopefully something else that has even more of kind of both the fundamentals and technicals. But overall, I think this is worth keeping an eye on, even if you're not in it, to see if it's working, right? Is the market rewarding this type of stock? 92 RS rating, composite rating is 94, relative strength is 94. So the metrics are there from our rating perspective, and then the kind of the annual earnings are moving up too. So I think this has enough there that's worth taking a shot, putting some money, and that, at least that's what I did. And we'll see if it works, right? If it doesn't work, I'll just cut my losses and move on at that point. But so that's one of the semiconductors. I had to get some exposure to the semiconductors because they have been working out pretty well.
So this one's a little bit extended now,
Yes.
and so again, you have to wait for your next shot. But certainly, again, if you just compare this relative strength and just the way the chart looks, compared to like SMH, for instance, SMH is the VanEck Semiconductor ETF, and this has been doing really well. Absolutely, on the technical side, it's made a nice gain from its October lows. Even this year, it's been one of the standout areas. But you can just see that ON Semiconductor was in a very different position. It was in that position where it just wasn't giving up ground as readily, and it was already getting to new highs. Whereas SMH, it's still well off its highs, and everything. But I'm glad you brought up the fundamentals. One other question I have for you is, this is something we're seeing in a lot of stocks right now, is the forward-looking estimates are not, we're seeing red, right? It's not that it doesn't have earnings, it still is profitable, but those profits are slowing, not growing. How much of a concern is that for you, since again we're just seeing it so prevalent right now?
Yeah, I mean, I'm keeping an eye on it, and I mean, so it is important. I mean, it's one reason why I'm a little bit more cautious, right? I'm not going in kind of with the classic 20% position if I'm making progress, right? At 10, you start at a 10% position, then if it's working, then you move it up to 16, and then finally 20. I'm nowhere near that. It's my position's around a 10% position, 7 to 10% type of position right now. So I've adjusted for that risk, and so yeah, the fundamental, kind of just the trends on the fundamental side, they do concern me. And so it is this really, and we're going to show you some other examples here where this is kind of closer to what we're looking for, but it's not ideal. And then we'll just show some other stocks that are working, that even from a technical standpoint isn't necessarily the classic type of entries that we look for.
Yeah. So, and as a reminder for folks that if you are listening to this, we are showing some charts as we're going through here. And if you ever want to take a look at that video, you can always find that at www.investors.com/podcast. Let's go ahead and switch over to ODFL. Now, Old Dominion, this is kind of, in the transportation truck area, this is one of the old stalwarts, right? This is, actually, let's start on the monthly on this one, because you might not realize what kind of move this has actually had over time. This is kind of like long-term leader status, because it has just these very, it just goes up. Not a screamer where people are like, oh yeah, I just really killed it on my ODFL. That's not something that you hear people talk about in cocktail parties, but it's one of those that it just over time has this amazing run. And if you look on the weekly chart, the EPS growth rate is 28%, and the earning stability is 12. Now that earning stability goes from 1 to 99. The lower the number, the more stable the earnings are. And a lot of times we find that those long-term leaders have very stable earnings, and ODFL is definitely in that vein. So here we have a EPS rating of 97 on the fundamental side. Strong, but again, we're seeing deceleration. Forward-looking estimate for 2023, a negative 2% there for growth. Not as bad, but it's not good. So that's on the fundamental side. What about on the technical side here?
Yeah, so the technical side, and I'll switch over. Well, I'll show this on the weekly charts. So this is a larger consolidation. So a lot of times when I see a larger consolidation, I'm always a little bit more hesitant on it, because it could be just a large trading range where there's a lot more volatility. But it did get past that essentially 300, 310 level right there, which is where a lot of the resistance was. And so that getting through that was definitely a positive. You see the relative strength line right at 52-week highs and 90 RS rating. Now, when I switch over to the daily, this is what I like. And so this is on my watch list. I don't necessarily own it right now, but it reported earnings, and you had a powerful earnings gap. And so that's telling me that, okay, the market at least is a little bit more optimistic about the stock. It was up 239% volume above average. And so there are some bigger players starting to move into the stock. And then over the last week or so, it's really just been kind of consolidating that gap in almost kind of a flag type of pattern setup right here. So it's had this really strong move up, and it was up 10% that day, and no one necessarily wants to sell it and lock in their gains. And so it's holding tight. So I do like that. And a lot of times when I see that kind of strong move and they hold tight, that's telling me that, this stock might have a chance to kind of just continue that momentum.
Right.
And a lot of times, you call that an earnings drift, or, there is a lot of momentum kind of coming in to those if they are powerful enough.
Mm-hmm. And it certainly speaks to the fact that, investors are comfortable with it at that higher level, that it's,
Yeah.
it had that gap up and it was able to kind of hold those gains. I think just, speaks to, hey, something fundamentally changed here. The valuation models for a lot of analysts had to change, and they're comfortable with it up at this level. So we're kind of at that three, I think the 355, you kind of saw some congestion there. If you go back to the weekly chart, you saw some congestion there, like in the November 2021 top.
Yep.
And so we're right back up there. So I think this is a perfect place for it to pause and take a little break, because a lot of times you can build another little platform from which you can launch off of and into further heights. So this is definitely one that's on my radar as well. I did like how it crossed that 325 level, that earlier resistance area that had gotten touched a number of times. It broke through that with conviction. So yeah, I'm hoping this pause gives us another shot at this one. And this is a group that we're seeing more strength in. It's number 45 out of 197. So that's pretty strong as well. Let's go ahead and wrap it up. One of the hard hit areas was certainly computer software enterprise, computer software database. A lot of these areas, they were the big growers in 2020, computer software enterprise especially, and they were also the hardest hit in after the 2021 top. So now this is something that's a little bit different. So explain how this kind of gets on your radar when it's not your typical, oh, look, this is something that had this big uptrend and is basing from it. This is more of a what we call a bottoming base, right?
Yeah. So how it gets on the radar, just looking at a lot of stocks and noticing and so if I pull up the IGV, which is software. So,
Yeah.
and a lot of times you can start running into this more if you're looking more from a sector level, an ETF level, if you're going through a number of those kind of charts to say, hey, you know what? On IGV, this is the first time it's over the 200-day or the 40-week line on this weekly chart in over a year, right? So maybe that's a character change.
Yeah.
Doesn't necessarily mean it's going to stay above it, but at least it's finally got above it. So that is a different kind of behavior that it's shown in over 12 months here. And then it's like, oh, how are the software stocks doing? And then and you can start drilling down that way. So New Relic is yet one of another example here. There are tons of software stocks that over the last few weeks, really, I want to say over the last 10 days, have started to get above the 10-day. And I'm sure ChatGPT definitely helped a lot of these stocks bring in some momentum and enthusiasm into this area. And now this is where it's tricky. A lot of these stocks are kind of coming off the bottom, or there's a lot of overhead supply, and they're far away from all-time highs, or at least 52-week highs, right? So maybe a little bit closer to 52-week highs because they've just been some of them have going sideways enough. But here's New Relic. We just went through some screens right before this segment right here, and New Relic just reported earnings, had a powerful gap up, and this is a character change for this stock. It's made a higher high for the first time in quite a while. Relative strength line is hitting a 52-week high, so you're getting the blue dot right here. You are starting to see an acceleration in earnings, right? 230 last quarter, 278 this quarter. The volume over the last 6 weeks is starting to improve, and so you are starting to see a shift here. But this is the problem, is these aren't necessarily kind of the classic type of entries that we look for. Now, this does have a prior uptrend
Right.
that it formed right in the
Yeah.
half last year, formed a base and it's breaking out. So the way I look at it is I really like the company and have a lot of conviction. I would consider it, right? And if it settles down and sets something else up, but it isn't kind of the traditional kind of entry. But these are a number of the type of entries or number of the type of stocks that have been working this time around and pushing up. And guess what? It kind of looks like the NASDAQ that's coming off the bottom, right? We've had all these additional fall days. It's coming off the bottom. It's not like the NASDAQ's right near its all-time highs. So it's not a surprise you're seeing a lot of these tech-related stocks coming off their bottoms or starting to make newer highs that they haven't done in a little while.
Yeah. And one of the things that I think is worth noting is, especially if this is going to be a rally that works, one of the things that, at least in the 2009, and we've talked about this on the podcast before, one of the things that I learned from Bill and watching what he did, because I didn't do 2009 so great. I was just late to the party. It was like these setups aren't, they're not pretty. They were some ugly looking charts that were still, below their 200-day lines when they were kind of when Bill was buying some of them. The only time I've really seen him buy below the 200-day line. But one of the things he pointed out was, look, when the indexes are making new lows and you're looking at stocks that are holding up.
Yeah.
And I feel like that's one of the things that stuck out to me about New Relic is, you had the stock bottom out in May and the market kept on making these lows and it was holding well above. It was still below the 200-day line, the 40-week line, all of that, the 10-week line even, but it was holding above. And so I guess that's what I'm looking for it to do right now is it had that strong earnings. And just like we saw with, some of our other examples, ODFL, can it hold that level now and kind of build a platform from which to build off of?
Yeah, for a number of these stocks, the bottoms, they made their bottoms in June, right? Not necessarily October, where the market might have made its bottom. So I think that's a really good point there. You are seeing a number of these divergences from these software stocks, and it really does bring me back to a lot of those masters classes that Bill O'Neill would do every December. And one of those lessons was this divergence. So I think that's a good point, and you might be seeing a rotation towards these software stocks. And if you didn't necessarily get into them at this point, if it's a true rotation, they're going to set up again. They should go up on an uptrend, 20+%, and form new bases and hopefully even more constructive bases.
Yeah, absolutely. So there's a few stocks for you to kind of keep an eye on, and more importantly, it's not about the individual stocks, but kind of the look that they have. So make sure that you're kind of paying attention to those elements, the relative strength, and everything else that we just talked about, because that's how you're going to find more of these stocks on your own. The whole idea of teaching someone to fish rather than just giving them the fish. So we hope you take that to heart. And thanks a lot for joining us this week. We'll be back next week with Brian Shannon. Gosh, this is just one of the great technical analysts. It's always a pleasure to have him on. We're also going to be talking about a new book that he has coming out, so we hope you join us for that. Some of the new things he's sharing in the new book. Yeah, we're looking forward to a great conversation with him. So hope you join us for that, and thanks so much for watching us this time. We'll see you then. Bye.
Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.